Okay, so today I'm going to answer one of the most asked questions, that if I only have $100 in a day, how much money can I make in the Forex market? Well, to answer this question, you have to choose. Are you going to go with the flipping account side, or are you going to go with the compound growth? And I'm going to explain these two sides and how they affect your trading. Now, what you have to know is that if you have $100 in the account, right, how many trades would you be willing to place if you were to lose all those trades? For me, this is the first thing that I do for my risk management. So if I'm creating a risk management plan for me or for anyone else, then that means I have to ask them, if you have this $100, how many trades would you willing to place until you lose all this $100? If you were to lose all those trades, the answers are going to depend on your financial situation. If you are someone who already have a lot of money, then on $100 you might want 2 trades. 1 trade, it's enough. But I don't think that you would deposit $100 if you have a lot of money to deposit, right? So I'm just assuming that this $100 is the amount of that you are saying, okay, if I lose this, it's not gonna ruin my life, but I still need this $100. So what you are going to do is you are going to choose how many trades. As I said, 10, right? Now let's say I choose 10. If I choose 10 trades, this means I'm going to be risking $10 per trade. Now, on each trade, I need to know what is my stop loss and how I adjust my position size to fit that risk to $10. I'm going to show you an example. Right here, you can see a trade that I placed right there. So this is an example, just to be transparent, right? This is an example. Let's say we are placing a trade here. This is a buy trade, right? And this is our first trade. We want to risk $10 on this trade, right? If you want to risk $10 from this trade, right, we are going to know that our stop loss is going to be here. How many pips is this? It's going to be 20 pips. You can see it written right there. So this is 20 pips, the risk that we are taking. Now we want to know what lot size do we need to use for us to risk $10 with this 20 pips. So I talked about this in another videos. I will link those. So in this case, our lot size is going to be 0.05 because we want to risk 50 cents per pip, right? So if you want to learn that, as I said, I have another articles and videos. Check out the link in the description here, right? If you are watching this on YouTube, right? So that would be my position size. So I know that if that happens, if I lose this trade, I'm going to be losing $10, right? So if I do this same type of position sizing and the same type of stop losses for 10 trades, and if I lose those 10 trades, of course I'm going to blame on the strategy, and I'm going to try to change the strategy, right? But then this is exactly how you calculate like how much you are risking, right? And why am I showing this? I'm showing you this because you have to understand that if you know how to calculate your position sizes, then it's going to give you on average how much money you can make with that $100, right? Now you have to understand that the risk that you are placing, right, is related to the win rate and the reward that you can make, right? So if in the market, right, if I place a trade with let's say I place a $10 trade to make $10, right? We call this 1-to-1 risk to reward ratio, which means I'm risking $10 to make $10. And the market give you a 50-50 chance at any given point if you have a 1-to-1 risk to reward ratio, right? So if I place these trades, right, the more I place these trades, if I'm risking $10, I'm likely to make for making $10, I'm likely to win around 50% of these trades, right? So in this case, if I win 5 trades and lose 5 trades doing this, then that means with $100, after these 10 trades, I only made maybe break even or $10 or $20. This might be fine for someone who want to be risk averse, which is the good way to do things, right? If I start to risk $10 to make $20, we are going to see what is going to happen is that my win rate, now I'm trying to make 2 times what I'm risking, right? I'm trying to make 2 times what I'm risking. And if this happens most of the time, right, your win rate is going to drop. So you are no longer going to win 55 out of those trades. You are going to probably win 3 to 4 of those 10 trades, right? But at the same time, you can make that profit back because of this risk to reward ratio that you are using, because now you are risking less to make more, right? So your potential gains are going to be higher, but then you are going to lose less because the market is going to go up and down at any given time. So wherever you are trading, you are going to see this. You are going to see that the bigger the risk to reward ratio, the less the win rate that you are going to have, right? So this way of placing your trades, it works very, very, very much, right? So if you want to be in the market for long, you can use this way of placing your trades. So this way of calculating how much time I have, right, you can calculate the risk that you are putting in place, right? On the flipping side, right, I want also to talk about on the flipping side, right? If you choose to do account flipping, right, which is what other traders prefer to do because they know that $100 is less, so I would just maybe risk more of it and then make profits quick, right? So what other people would do is they would probably take $20 as their initial risk, right? So from that $100 you take $20 as your initial risk, and then you start placing multiple trades, right? And then if those trades start going against you, if you lose $20 you are out, but if they start going in your direction, then you start staking up on those trades to make more. So it will look something like this. I think you have seen a lot of things like this. People do this, it's riskier, but they do this because if you do make money, you probably are likely going to grow your $100 maybe from 100 to 2,000 to 1,000 in one trade, or in a single move, or in a few minutes, right? Because what you do here is you see the market moving, let's say to the upside, and then you buy initially here, and then if it does go to the upside, you add more trades, because the more equity you have in the as the trades are going, right, the more you are going to have as your margin to keep buying more and more and more, right? So some people would like to do this, right? So they'll say, okay, I need 5 chances to do this. So firstly, I'm going to risk the first $20. I'll place like 5-6 trades, right? And if the trade starts going in my direction, I'll keep adding and adding and adding. If things go wrong, I'm going to lose maybe $20 to $50. And if I do this like 4 times, 5 times, I've blown my $100 account, right? So what I want to tell you is that if you only have $100, in a long term, compound growth will always beat flipping. But here's the thing. How long is long term? Because in 10 years, 5 years, 6 years, a year, compound growth might give you more, because if you grow this account like to 150, you can increase the amount you are risking from $10 to $15 per trade. From there, if it grows, you increase that to 20 to 40 to 60, and then, but this will take a long time. If you have very high risk appetite and you are not valuing that $100, you might want to go to the flipping side, because the flipping side, you can turn $100 to 1,000, and then you might have like another 4-5 days of losing those $100. So in a long run, compound growth is always going to be king, because it is said to be the 8th wonder of the world, right? But in a short period of time, and if you have a very small account, like for example, let's say you have $20 in your account, are you going to compound growth $20? No, you are not going to do. Compound growth works well if you have bigger accounts. If you are doing prop trading maybe, or you are trading with other people's money, like kind of a fund, which I don't think you are doing that. So depending on your account size, you choose which side you want to go, and you can learn to do all these things. But the flipping side is dangerous. The compound growth side is a little bit safer, but it takes long term for you to see your account growing to good sizes. Now, if you want to learn how to calculate your position size and how to find the best positions to place these trades, make sure you check out the link in the description. If you are reading this on our website, just check out this link below, and then that is going to be it. And then I'm going to see you in that video. Thank you for watching. I'll see you in the next one.